Good morning. My name is Tommy Tan. Welcome to my world. You'll spend today with me learning about Celli in a very fun way. Throughout our journey together, we will meet my family and friends. Let's say hi to my teacher, Miss Sandy. She's my favorite teacher. She teaches me many things about investment-linked life insurance. My mom. She's pretty and I love her a lot. She bakes yummy cookies. My dad. When it comes to money, he's the boss. My best friend. Her name is Stephanie. We've been best friends since kindergarten. My dad's friend, Uncle Samuel. He's an insurance agent, just like you guys. I've always admired his professionalism. Well, you've now met my family and friends. Let me take you on a journey through a day in my life.
Tommy, are you done? It's time to go to school.
Yes, Mom, coming.
Good morning, class. Today, we will be learning about the introduction to investment-linked life insurance. The insurance industry in Malaysia has grown steadily for more than 15 years. According to Bank Negara's report in 2009, the total number of new life insurance policies has grown from 498,338 policies in 1990 to 1,403,562 policies in 2009. The reason for this growth is due to the introduction of customer-focused and investment-linked life insurance plans. An investment-linked life insurance plan offers a policyholder a policy that is directly connected to the investment performance. From the premiums paid, the policyholder will receive an amount of protection while the rest will be invested in selected funds. The insurance company may also channel these funds to an appointed fund manager to be managed. If the funds do well, the policyholder will make a profit. If the funds do badly, the policyholder may lose all the premiums paid and also the coverage provided. Investment-linked funds are invested in areas such as stocks, bonds, real estate, currency, and so on. Investment-linked insurance plans are not new in the insurance industry. Different terms are used in different countries when relating to investment-linked insurance plans. In Malaysia and Singapore, it is known as investment-linked, while in the United Kingdom, it is known as unit-linked. In the United States of America, it is known as variable life. My dear students, that's enough for today. Let's see how much you have learned, okay? Turn to the friend next to you and share what you have learned today.
Let's see. Today I have learned a few new things. 1. What is an investment-linked insurance plan? An investment-linked insurance plan offers a policyholder a policy that is directly connected to the investment performance. 2. From the premiums paid, the policyholder will receive an amount of protection while the rest will be invested in selected funds. 3. If the funds do well, the policyholder will make a profit. If the funds do badly, the policyholder may lose all the premiums paid. 4. Different countries use different terms for investment-linked plans. In Malaysia and Singapore, it is known as investment-linked, while in the United Kingdom, it is known as unit-linked, and in the United States of America, it's known as variable life.
Well done, everybody! I am sure you have learned a lot today. Make sure you complete your homework, and I will see you tomorrow.
Hi, son. Had fun in school today? What did you learn?
School was fun. Miss Sandy taught us what an investment-linked insurance plan is, how the premiums work, and what investment-linked insurance plans in different countries are known as.
Looks like you learned a lot in school today.
Yeah, Mom? Where are we going now?
Before we go home, let's drop by the bank.
Yay! Mom, why do people put money in the bank?
Because they want to save and invest their money.
Oh, then what are their key considerations when they decide to invest?
Son, the key considerations before investing are 1. Investment objectives. 2. Funds available. 3. Risk or security. 4. Investment horizon. 5. Accessibility of funds. 6. Taxation treatment. 7. Performance of the investment. 8. Diversification. Investment objectives are the purposes and reasons an investor invests his money. Investment objectives have 3 fundamental characteristics, namely 1. Safety. Government bonds, treasury bills, and fixed deposit accounts are safe investment instruments. However, these investment instruments provide a low rate of return. 2. Income. Safe investment instruments provide low rates of income, while risky investment instruments provide higher rates of income. 3. Growth. Stocks, commodities, and shares are examples of growth investment instruments. Growth investment instruments help investors increase the value of their capital over a period of time. Availability of funds. Developing a personal budget helps the investor to control spending and find enough money or funds available to invest for his desired needs. Risk or security. There is a trade-off between expected return and risk in investment. The higher the risk, the higher the potential return. The lower the risk, the lower the potential return. This means that if an investor would like to receive high returns, he would need to take more risks. Investment horizon. Investment horizon is the amount of time the investor decides to invest his money. The investment horizon depends on when the investor wants to withdraw his investment. If he needs the money in the near future, he will have a short investment horizon. The shorter the investment horizon, the less risk the money invested is exposed to. Accessibility of funds. When considering an investment, an investor would like to know how easy it is for him to access his funds when they are being invested. The accessibility of funds will depend on the following conditions. Duration of investment. The funds would not be easily accessible if it is invested in long-term investments, such as real estate and long-term bonds. Early exit cost or penalty. The funds are considered not easily accessible if the investor is imposed an early exit fee for withdrawing the investment before the maturity date. If the cost of early withdrawal is high, there is no point for the investor to withdraw his funds early from the investment. Cost of investment. It is important for the investor to know the amount of money that is needed for investment. Taxation treatment. Different types of investment portfolios are taxed differently. However, investment-linked plans enjoy the same tax treatment as traditional plans. Performance of the investment. The performance of an investment depends on the following factors. 1. Country's economic factors. 2. Regional and global economic factors. 3. Competencies and capabilities of the management team. 4. The invested company's level of costs. 5. Past experience. 6. History of the company invested in. 7. Life cycle of the investment. Diversification. Diversification is the process of spreading an investment over many investment vehicles. This is like putting a person's eggs in a few different baskets. The risk of all eggs breaking is low because if one of the baskets were to drop, The other eggs in other baskets will still be safe. Do you understand what I shared with you?
Yes, Mom. You shared with me that a good understanding of the key considerations is important before we get into an investment. Those key considerations are 1. Investment objectives. 2. Funds available. 3. Risk or security. 4. Investment horizon. 5. Accessibility of funds. 6. Taxation treatment. 7. Performance of the investment. 8. Diversification.
1, 1, 2, 2. Counter 1.
Oops, that's us. Let's go.
What have I learned today? I have learned about key considerations in an investment, which are 1. Investment objectives. 2. Availability of funds. 3. Risk or security. 4. Investment horizon. 5. Accessibility of funds. 6. Taxation treatment. 7. Performance of the investment. 8. Diversification. Phew! I'm so tired.
Little boy, stop running around because it's making me dizzy. Why don't you come up here to check out the view?
Yeah? Why not? Mr. Tree, why do you have so many different kinds of fruits?
Let me tell you how it all happened. I am an investment tree. My fruits are investment assets. Over the last 15 years, the investment choices available has steadily improved. The government is very proactive in promoting the growth of these areas.
I see.
Little boy, do you want to know more about the different types of investment assets that I have?
Yeah, I want.
Cash deposits are very liquid and provide low returns. There is very little risk of losing the principal. Cash deposits are not considered investments as its values usually don't increase or generate income. Cash is used to buy things. It is used as a means of exchange for things. Treasury bills are issued by Bank Negara Malaysia to the discount market when the government needs extra funds. Treasury bills are known as short-term debt instruments. The government makes short-term borrowings from its citizens. The duration borrowing is for 1 month, 3 months, or 6 months. There is almost no risk in investing in treasury bills because the government guarantees to pay back what they have borrowed. Investors buy the treasury bills at a discounted price, lower than the original price for treasury bills. Treasury bills are also known as money market. Bank accounts are time or fixed deposits placed with banks of fixed periods. Bank accounts provide fixed interest rates. The longer the deposit period, the higher the interest rate will be. Some of the accounts available are savings account, current accounts, fixed deposits, investment accounts, time deposits, and offshore accounts. The factors that may influence the choice of deposits are as follows. Funds available for investment. The duration the funds can remain in the account. Whether there will be emergency withdrawals. Prevailing market conditions. Perbadanan Insurance Deposit Malaysia (PIDM) was set up to further strengthen the confidence level of depositors.
Mr. Tree, what is Perbadanan Insurance Deposit Malaysia, PIDM?
PIDM is a government agency established under the Akta Perbadanan Insurance Deposit Malaysia 2005 to protect against the loss of a depositor's deposits in the event of a bank failure. Its objectives are to administer a deposit insurance system, provide insurance against the loss of part or all of the deposits of a financial institution, provide incentives for sound risk management in the financial system, promote and contribute to the stability of the Malaysian financial system. Besides the above-mentioned objectives, PIDM's main functions are to assess and collect the fees from banks, manage and monitor the deposits by depositors using the systems, take over the deposits should banks have to wind up or close down, reimburse depositors, part or all, comply with Sharia principles on Islamic deposits. Investors buy fixed income securities to get an income known as coupon or periodic income. Usually the company which issues fixed income securities, known as issuer, is a company or government. Fixed income securities do not offer capital appreciations or increase in value. Fixed income securities can be bought or sold before they mature or expire. They can be bought and sold in secondary markets. The types of fixed income securities are money market instruments, which are short-term investments, government bonds, which guarantee its principal and have low risk of default, corporate bonds, which are high-risk bonds. Corporations tend to default on payment, but the potential returns are high. Preference shares.
Mr. Tree, what are the differences among all types of fixed income securities?
Government bonds are used by the government to borrow money from the public. They are the most preferred bond types as the bonds will not be defaulted. The government guarantees investors interest payments. Government bonds can be classified according to the maturity period as follows. Short-term bonds, usually less than 5 years to maturity. Medium-term bonds, usually 5 to 10 years to maturity. Long-term bonds, usually more than 15 years to maturity. Company bonds. When a company intends to be publicly listed, it needs to raise money, capital. The money is raised by the company through the offering of bonds in the form of debenture stocks, loan stocks, or convertible stocks. Investors who buy corporate bonds become bondholders to the company. Boy, you must be wondering, what is debenture stocks, loan stocks, and convertible stocks? Let me explain each of them to you. Debenture stocks are stocks with a security or guarantee on the physical assets of a company. So if the company fails, investors can sell the assets to get back their money. Loan stocks are the opposite of debenture stocks. Loan stocks do not have a guarantee on the company's assets. If the company fails, investors may not get back their money. Convertible stocks are stocks with the option to convert ordinary shares to preferred shares on a fixed date. The benefit of this is that the investors can become a part owner of the company. In general, corporate bonds tend to provide higher returns than government bonds. For some investors, they are also more marketable and can be sold for capital gains. However, they are more risky than government bonds. Investors who invest in shares are called shareholders. A shareholder is a part owner of the company. One of the advantages of being part owner is that shareholders can vote. If they cannot be present, they can send representatives to vote on their behalf. Companies can be either public or private. Investment in private companies is only available to selected investors or brokerage houses. When a company is private, ordinary public investors cannot gain access to the company's profile. Public investors can gain access on any information about public companies. Share prices are influenced by 1. The market's view on the company. 2. The country's economy. 3. The interest rate levels. 4. The inflation rate. 5. The company's earnings. 6. The currency performance. Differences between ordinary shares and preferred shares are: ordinary shares may or may not receive dividends. Dividend rates fluctuate according to the company's profits. Preference shares. Investors have the right to a fixed dividend, provided enough profit has been made. Investors may not be paid if profits are not made. The dividend is fixed. It is more secure but less profitable. It ranks ahead of ordinary shareholders when the company winds up. Advantages and disadvantages of investing in shares. By investing in shares, the investors participate directly in the future of the company. Shares also provide good dividends and capital appreciation. They are also very liquid, as shares can be traded in the open market. However, shares can be very risky, as the value can go below the price the shares were originally bought for. Unit trust is a collective investment in funds by many investors. There are three parties involved in a unit trust operation. They are the unit holder, the trustee, and the unit trust company. A unit holder is an investor who invests in unit trust. The trustee will ensure unit holders are protected should the unit trust company fail. The unit trust company manages the unit trust fund. When a unit trust is purchased, it will be converted into units. Unit trust offers potentially higher returns than fixed deposits. However, unit trust comes with risk. The trusts are open-ended funds. If too many investors sell their units, the trust will have to sell the fund's assets. The advantages of investing in unit trust are spread of investment, lower risk compared to shares, professional fund managers, minimizes paperwork for investors, income from dividend can be reinvested, EPF contributions can be used to invest. The disadvantages of investing in unit trust are bewildering array of funds, extra costs for sales charge and switching. Investment trust is similar to unit trust. The main difference is that investment trust is a closed-ended investment. This means that the investment will only be open for investing for a specific time frame. An investor purchases shares from an investment company. The company will invest in a wide range of investments. The investment trust fund is managed by specialist fund managers. The profits increase the value of the fund and the value of each investor's share. If the trust suffers losses, then the investor's share will be reduced in value and the price of his units will fall. The difference between investment trust and unit trust is that the investment company of the investment trust is registered under the Companies Act, while unit trust is formed by a trust deed. An investment trust purchases shares of a company, while a unit trust purchases units in a trust of a company. An investment trust fund is a closed-ended fund, while a unit trust fund is an open-ended fund. Assets will not be disposed from an investment company if too many investors cash in, while the opposite is true for unit trust. The advantage of investment trust is that investors can borrow to finance the purchase of investment trusts. The flexibility to borrow funds to purchase the investment trust also means that investors are open to greater risk exposure if the price of investments suddenly goes down. There are basically three types of real estate investments. 1. Agricultural property. 2. Domestic property. 3. Commercial or industrial property, both locally and overseas. The price of an agricultural property depends on the following factors: quality of land as reflected on the quality and profitability of crops it grows, the location of the land, the value of the buildings on the land. On the other hand, the price of domestic and commercial or industrial properties generally depend on the location and types of buildings on the land. REITs. A real estate investment trust, or REIT, is a company that buys, develops, manages, and sells real estate assets. REIT is an investment concept similar to unit trusts. Investments in REIT provides opportunities for investors with little property knowledge and capital to invest in properties. Investors will receive dividends via rental income from the investment in REIT. The advantages of REIT investment are: 1. Good capital appreciation. 2. Steady flow of income. 3. Low risk. 4. By mortgaging, capital can be freed. Disadvantages: 1. Difficult to dispose during recession. 2. Extra cost if there are bad tenants. Derivatives. Derivatives are financial instruments whose values are linked to the price of underlying instruments in the cash markets. Two popular derivatives are stock options and financial futures. Derivatives have a high potential of return, but comes with very high risk. Derivatives can be traded, buy or sell, via futures or over the counter. Option. An option is a right. The word option means having the right to exercise to buy or sell or not. A call option is a right to buy, whereas a put option is a right to sell. Call options are bought in hopes that the price will increase. Sellers want the reverse to happen. Put options are bought in anticipation of a decline in price. Sellers want the reverse to happen. Warrants. A warrant is a derivative security, equity, that gives the holder the right to purchase the equity from the issuer at a specific time for a specific price. The holder may subscribe to the shares in the company at a predetermined ratio, conversion ratio, at a predetermined subscription price, exercise price, and within a specific time period. The lifespan of a warrant is fixed at the beginning and cannot be varied. Warrants are issued and guaranteed by the company. The advantages of warrants are: it requires a small sum of money to start the investment. An investor who intends to buy a warrant only needs to pay the exercise price later and to convert the warrant to the underlying share. Investors benefit from capital gains from the sale of warrants. The disadvantages of warrants are: on expiry, if warrants are not exercised, the investors will lose his investment value completely. There will be no chance for price recovery. No interest or dividends will be given for warrants. Warrants carry no voting rights. Commodities are investments in areas such as food, precious metals, gold or silver, livestock or financial instruments. The actual buyer and seller trade in the cash market. There are two types of cash markets. They are known as spot markets and forward markets. In a spot market, the spot price refers to the current market price. This item will be delivered immediately after the price has been paid. In a forward market, the price is paid first. The item is delivered in the future or at a later date. Stock index futures are futures contracts. Share index futures are based on a particular share price index. It is used to measure the overall price movement of a stock market. The advantages of investing in commodities are: 1. It enables investors to protect their investments through the concept of hedging. 2. It shifts the risk of price fluctuations to those who are willing to accept it. 3. It leads to price discovery. Price discovery is a situation where a futures price reflects current expectations. 4. It leads to potential large gains through speculative trading. The disadvantages of investing in commodities are: an investor may face huge losses if he speculates wrongly. An exchange-traded fund, ETF, is an investment fund traded on stock exchanges. Investors who are inexperienced in investing in the Malaysian stock market may buy into the KLCI ETF index. The KLCI ETF index tracks the KLCI index closely. Institutional investors buy or sell shares of an ETF directly from the fund managers. Individual investors trade an ETF on the secondary market via a broker. An ETF combines the valuation feature of a mutual fund or unit investment trust. It can be bought or sold at the end of each trading day for its net asset value. SUSO. SUSO is the Arabic word for Islamic bonds. It must comply with Islamic principles. SUSO is similar to conventional bonds. The difference is that SUSO represents ownership of assets, while conventional bonds represent debt. SUSO has the following characteristics. They are issued by pooled funds. They are based on tangible assets that generate steady income. They may or may not be guaranteed. Investors receive a fee equal to that of underlying assets. They are issued by special purpose vehicles, SPV. They are different from conventional bonds because they are based on tangible assets instead of debt. The most common SUSO today are SUSO al-Ijara and SUSO al-Musharaka. Capital Guaranteed Fund. Capital Guaranteed Fund guarantees that the investor does not lose his initial capital. Capital guarantee funds invest 80 to 90% in guaranteed investments. The investment horizon of the fund is usually 3 to 5 years. Usually, a capital guaranteed fund is a close-ended fund. The fund is open for investment for a certain time only. The advantages of a capital guaranteed fund are: 1. The investors is sure to get back their capital. 2. The investment imposes a very low sales charge. The disadvantages of a capital guaranteed funds are: the investment provides low returns. However, the returns are slightly higher than fixed deposits. The investment requires a higher minimum investment compared to other unit trust funds. The penalty for early redemption ranges from 0.3% to 1.5% of NAV. Fees paid to the guarantor may erode returns. That's quite a lot that we have talked about today.
Yeah, I've learned a lot today.
What are you both talking about?
We talked about the investment choices that are available to today's investors. The common instruments include cash and deposits, fixed income securities, shares, unit trusts, investment trusts, properties, derivatives, commodities, annuities, exchange-traded funds, sukuk bonds, real estate investment trusts, capital guaranteed funds.
Tommy, wake up!
Previously in Chapter 3, Tommy learned about the 14 types of investment assets. They are: 1. Cash and deposits. 2. Fixed income securities. 3. Shares. 4. Unit trusts. 5. Investment trust. 6. Property. 7. Derivatives. 8. Commodities. 9. Life insurance. 10. Annuities. 11. Exchange-traded funds. 12. Sukuk bonds. 13. Real estate investment trust. 14. Capital guaranteed funds.
Tommy, wake up! Can you help me get the mail from the post box?
Okay, Mom. This postcard is from Auntie Annie. She says that the investment-linked life insurance business has been transacted in the United Kingdom for more than 30 years. The first investment-linked life insurance contract in the United Kingdom was an individual retirement annuity for the self-employed. It was introduced by the London and Manchester Assurance Company Limited in 1957. The first of the new generation of investment-linked life insurance products was the Hambro Whole Life Plan, introduced in 1977. This postcard is from Uncle Sam. He says that, in the United States of America, investment-linked plans are known as variable life insurance. It was offered to the general public in 1976. The marketing of variable life was pioneered by the Equitable Life Assurance Society. One of the factors which contributed to the expansion of the life insurance industry in Singapore was the introduction of the Enhanced Investment Scheme, EIS, by the Central Provident Fund, CPF, in 1993. This postcard is from Pakcik Rais. He says that Syarikat Takaful Malaysia Sdn Berhad, now Syarikat Takaful Malaysia Berhad, was the first to sell a simplified product to the public in August 1985. In July 1997, Berjaya Prudential Assurance Berhad became the first traditional insurance company to launch the investment-linked life insurance product. Maybank Life Assurance Berhad was given approval in February 1998, followed by Malaysian Assurance Allied Berhad. Takaful Investment Linked was developed as a response to the religious principles and practices of Muslims. The premium received under Takaful Investment Linked are invested in stocks and other assets that comply with the requirements of Islamic law and principles.
What's in the mail?
These postcards are from aunties and uncles. They wrote to us to tell us that investment-linked life insurance has been around for many years in all parts of the world, such as the United Kingdom, USA, Singapore, and Malaysia. In the United Kingdom, investment-linked life insurance has been known as unit-linked since 1957. In the USA, investment-linked life insurance has been known as variable life since 1976. In Singapore and Malaysia, investment-linked life insurance has been known as investment-linked since 1973 and 1985 respectively.